Everybody, all is well, and you're enjoying the warmer weather here as we move through spring and get closer to the summer. As always, got some charts for you about where we've been in the markets, where we could be headed, and some interesting charts towards the end about real estate and the markets as well. So here we are, the S&P 500. You're probably well aware the markets dropped in March with the news of the Iran war, but over the last 8 weeks, we've been on quite the rally. Markets back up over 10%, which you can see is above the average, that orange line there that we've seen over the last 35 years. Of course, those gray lines being every single year, and you can see the volatility there. So we'll see where this takes us through the rest of the year. You can see 1995 being the strongest year, 2008, the financial crisis there being the weakest year over that period. But right now, slightly above where we've averaged over the last 35 years. Could we move forward? Could we move higher here? This chart's actually showing, so price earnings ratio has moved up as we move here, but what the forward-looking earnings projections have actually been higher than that 10% we've received on the market so far. So the sign there being that the markets are actually cheaper now than they were at the beginning of the year, despite moving up 10%. If you're using forward-looking earnings projections from the companies in that S&P 500. So a good sign there that markets could have more room to run here as we move forward if the economy continues to pick up and get a little stronger and companies are able to meet those expectations for forward-looking earnings. Another positive sign here, as mentioned, we had that 8-week rally, 17% return in the 8 weeks since that low in March. You can see over 4, 12, 26 weeks, very positive, but there is a few cases there where we have a negative return over that time. But if you look out 1 year later, a much higher return than average at 16.9% compared to the average year. And of course, 100% of those times, going back to 1955, when we've seen an 8-week rally like we've seen, markets have been positive. So we'll see if that holds true, but historically looking good there. I put this up numerous times in various ways, just to keep in mind that we have these geopolitical events. We just had another one with the war in Iran in March. Obviously, the markets have rebounded quickly, like we saw with COVID. Markets rebounding after about six weeks or so of negativity. Markets rebounded quickly there as well. Sometimes it doesn't happen that quickly, but we do get through it. So making sure your plan is in place. Short-term money is in lower risk options, but your long-term funds, just know they're going to be okay, despite what comes at us. If it's something we're dealing with now, which of course the war in Iran not over, war in the Ukraine, also no resolution there, or if it's something brand new we haven't even thought of yet or seen a hint of yet, we'll get through it. Markets will move higher. This is an interesting one. I didn't quite realize how high the profit margin was on Nvidia. So the kind of dominant chip maker, 71% net profit margin for the largest company in the world right now. This it just amazes me, and you can see the profit margin continuing to grow there. You don't generally think of those large companies having such high profit margins because they have such giant revenue. They can afford to have lower profit margins, but to have the billions of dollars of revenue that they're creating with that type of profit margin, just amazing. You can see why the stock has been on such a run lately. Looking at the housing market, so interesting one here. We know the housing market has been soft in Canada, and especially in the larger markets that ran up so much going back into the early 2020s. The Toronto markets, the Vancouver markets. So we're down almost 30% right now on a real price scenarios. And again, higher weightings to that in the larger markets. You can see incomes rising over the last 5 years. So that gap is getting closer and closer, but still relative to the US, such a large gap between incomes and the housing prices. There's definitely a case to be made that housing prices could continue to fall, or could flatten out here while income continues to rise, and that brings that gap closer. Not to say we can't spike up again as we saw in the early 2020s, But if we're going to go with kind of returning to the mean type of scenario, then there is a case for housing prices to continue to drop. And this is an interesting one, probably not surprising, but the single family home starts, the red line there, you can see that dropping over the last 35 years or so, while the multiples, the townhouses, the condos continue to rise. In about 2005 or so, that flipped from single family homes being built at a higher pace, and probably forever now the multiples will continue to pick up and be a much higher percentage of the total housing starts in Canada. As mentioned, probably not a surprise, but interesting to see in a chart form. This is about a bit of a softer one, but you really do learn this as you move forward. When you're younger, you have this high value towards things, whereas as you get older, you realize that it's the experiences, it's the vacations, it's the time spent with family and friends that really matters and really compounds as far as value goes for you. So as you look forward to the summer, you keep that in mind, and as you move forward, looking at the geopolitical events and the news headlines that are generally negative, keep this in mind and plan some things for the summer that will continue to compound for the rest of your life as far as memories go with family and friends. So enjoy the weather. As I said, we'll be back in a couple weeks with more charts. Anything in the meantime you want to chat about your investments, about financial planning, make sure you're on track, just let me know. Happy to chat anytime. Until then, take care everybody, and we'll see you soon.